Welcome to Business Lunatics again. This is the weekly show where four fearless loonies pull back the curtain on the wild, the wonderful, and sometimes the downright ridiculous world of entrepreneurship. There's no fluff here in these shows. There's no BS, just business madness. And on that note, today we're going to be talking about finances, invoicing. We're going to talk a little bit about accounts receivable and the experiences that these four loonies have had across so many years. And on that note, Freddie, you got a good story to tell about accounts receivable. So take it away.
Well, it's going to be, before we get into accounts receivable, I think that we really need to talk about chart of accounts because it really all starts there. And a lot of times people just wing it and they set up these accounts and they're really not set up properly. That sets the tonality and the situation of that company is off on the left foot instead of a right foot. And now all of a sudden, the data that they're getting back because of the chart of accounts is not correctly set up is really not valid data.
When you
And
say chart of accounts, what do you describe that? I mean, I'm trying to get a perspective of what that looks like.
For example, if you got services, how are you going to categorize your services? Are you, breaking down the services to different service types? Do you have resources that you're bringing on? So if you're working with contractors, how are you classifying the contractors? What are you doing for your marketing? What are you doing for a multitude of other things, your payroll? I've seen it where, people have had their business car into the system and not charted properly. They've had personal loans that they've tied into the chart of accounts incorrectly. And so it becomes a nightmare. And this one company that I work with, we ended up having to hire in a forensic CFO to come in. And the first thing they did was clean up the chart of accounts so that they actually made sense in an organized way.
I was
That's
gonna
more on the
ask,
accounts payable side now, right? Trying to organize
no,
how you're
receivables
It's
too.
structured.
it's all it's
No,
all of it. It's all of
it's
it.
both. It's
Okay.
both. It's
Both.
receivables, payables. It's if I sell an hour of service, I classify it one way, and it might go to which account so that it can yield zero out. It is up to the accountant. I would highly recommend anybody starting a business, it's worth it to pay your accountant a couple $100, whatever, to set up your chart of accounts.
Right.
If you use something like a QuickBooks, you could go in and it'll ask you, what kind of business are you? I'm a service business. Okay, great. Do you sell any products? No, I only sell service. Great. It'll set you up a chart of accounts based on a service type business.
But you
But
should
it's
still have it looked at
yeah,
after because that's just the starting point. But a lot of people use that starting point and then never go back and take a look at what it is and does it make sense for my type of business? And things evolve as your business grows.
And from my personal experience, I can tell you that in '94, when I started the internet group up, that was the first time I said, you know what? I need a professional accountant. And that was the first thing I offloaded because of the volume that started to be created. It was one thing when we were just a traditional media company and we had a limited number of clients and a limited number of work that we did. It was another thing when the internet came around and all of a sudden we have all these different services that came across. So what you're saying is right on target. I mean, I don't know that I necessarily called it chart of accounts at the time because I'm not a finance guy. But first thing I did was offload accounting. Just
we used
find
to
a
say set up your
professional to
accounts.
do it.
Yeah.
Set up your
And
accounts.
the other thing that people do that I've ran across that is they invoice improperly. One of the things I learned from this forensic CFO was that, you did the work in this month, but you invoiced it in the following month. And that's really
Hmm.
not correct.
Yeah.
You really should be invoiced in the month and tied to the month that you actually did the work with.
Yeah, the
And
question is when do you book it? When do you
right.
book that sale?
And so that starts the snowball effect of things being out of whack because your numbers are not correct per the period.
And that really
Well,
comes
that
down to if you spend $1,000 on your widget materials this month, and it takes you a month to make them, and then you sell them in the next month, where do you actually book that money in or out? So one month it's going to look like you spent way too much money because you used all these materials. And then the next month you're going to have an abundance of cash. It's going to be great because you made the sale, but you really should book it back to where you actually did the purchase of the materials.
I mean, doesn't this get into accounts receivable again, and it gets a little bit into cash flow, try and show exactly what does the real world look like? Because at the end of the day, you get so many entrepreneurs looking at what's in the checking account. And it's like, okay, that's great, but this is you've got your AR, you got your AP, you got your balance sheet, you got all these different things going on in this direction that you need to pay attention to. It's not just what's in your checking account.
But the
Well,
best part is every dollar you make, your employee thinks you keep 80 to 90% of it. If they only knew that you were keeping maybe 15 to 20% of it, because
Exactly.
you got expenses and you got payroll and you got insurance and
Yeah.
overhead and lights and you can go on forever.
Unemployment insurance, Medicaid, Medicare,
Every
Social
employee I've
Security.
ever had thought I was the richest man walking. And I'm like, why are you driving a BMW and I'm not? I just, what's wrong with this picture? And that's what
Yeah,
I
yeah,
realized.
yeah.
Wow, I got to make some changes.
First of all, what I find with a lot of clients, and this is where your accounting is so important, I find with so many clients that they're spending the most amount of time, money, and effort in a part of their business that produces the least amount of revenue, but because it's the most comfortable thing for them to do. So if you don't go over your books, you got to talk to your accountant. You can't just, come there during taxes. They've got to literally explain it to you. What are you doing that's right and what are you doing that's wrong? Here's what I gotta say. Numbers tell a story.
Oh,
But
yeah.
what's the story? Is it exciting? Is it a drama? Or God forbid, a tragedy? And the only one that can really tell that story, look, talk to your accountant. And that's what they're there for. They're there to dissect it and explain it to you because most business owners do not know the detail of it. And very often they're embarrassed to ask. And my thought is be embarrassed, ask, and have them explain it to you and tell them, I want you to explain. This is what I did to my accountant. I said, I want you to explain this to me as if you're talking to my 5-year-old Shih Tzu dog. If my dog can understand it, I will understand it. Other than that, I don't want to hear the finances. Break it down so that I actually can recognize it. And
And
the area that a lot of clients, this is another big, I talk about a red flag. This is like the house is on fire. You have accounts receivables and you say, you know what, I have $100,000 of worth of revenue coming in. Hello, when? Now, this is my thought. An account is an account only if it pays. If not, it's
Mhm.
called a hallucination. So when somebody tells me they have all this money coming in, I'd say, I'd like to know when. Because if you're just thinking that if that it's coming in, unless it's cleared in your account, you cannot,
not coming in.
you can't count on it.
No.
And then I have other clients that these accounts receivables have been like, a year and a half old. Like, what are you waiting for? Do you think Jesus is going to come in and save it? I said, you have to go to a collection agency. And they say, well, I don't want to spend 30%. And then I said, let's get clear on math. 100% of zero is zero.
30% of the money is 30% of the money.
right.
100% of
Or
if they're
70.
collecting money and charging 30%, at least you get 70.
Yeah,
But if
yeah,
you're
yeah.
not getting anything, what are you? You don't have the time to go after this. Are you talking
Well,
about how many calls that you have to make? What you need to do to collect on it?
It shouldn't cost you to do business in that regard of having to chase people down for money. Flat and simple. If they're not paying, fire them, get people who will pay you who appreciate what you do.
But you also
but
got
you
to
brought,
get, at
yeah,
some point, you got to get it off the books because otherwise it's
yeah,
polluting the books.
yeah.
Because again, with that one company I was talking about, they had that, that they carried for 2, 3 years because they figured someday they were praying that they would
Oh, I
potentially
have.
get cash. And it was like, no, you got to get this off the books. It's dead
What
money. Forget it.
I
Well,
And
there's
it's
a benefit to getting it off your books because you can then have it as a write-off, which will help in how much taxes you pay.
right.
So
I
there's some
had a
benefits to
client that
doing
had
it.
I had a client that had so much debt, and I looked at it and I said, "You think that your person that you're paying $20 an hour is going to collect on this?" I said, "Are you crazy?
No
They're not
way.
afraid of
No
her."
way.
I
Yeah.
said, let me tell you what you're doing. You're playing golf. He goes, what are you talking about? I said, every owner of this company you're friendly with, correct? He goes, yes. I said, do they play golf? He said, yes. I said, you're playing golf and you're collecting your money. You're calling them up while I'm
Yeah.
here. You're going out, you're playing golf. He's going to be too embarrassed not to pay you. And they collected a fortune. He's not going to tell this guy as you're playing golf that I'm not paying you.
Right.
But your worker that's only getting $20 an hour, they couldn't even care. She can call 100 times, she won't collect.
Right.
So you have
Well,
to know who's the person of authority that you can sick on the account so that you can get paid.
Rochelle, you mentioned twice now in your comments about this concept of being embarrassed. And I agree wholeheartedly with you. I mean, I think part of the problem is the fact that people are embarrassed that they're not managing this, and it partly is because they don't understand it, right? But they're not willing to admit that they don't understand it. I was kind of going to build on the idea that you had before. I think the way to look at this is your accountant, okay? Think about going to talk to your accountant as though you are going to the confessional, okay? It's between you and the accountant. Believe me, there's nothing to be embarrassed about. It's not like the accountant's going to share it with the rest of the world. Just turn around and just get over yourself. Just
You know what my thought
learn
on
about
But
that is?
yeah, but
My thought on
let
that
me
is they've seen worse. No matter what I show them, they've seen worse. So
right.
I don't have an
Oh, I'm
advantage.
sure. No doubt.
Yeah. Going back on what Rochelle talked about of collecting money, I'm going to share a tactic that we utilize at this one company that actually was very successful. And what I had was the accountant at the company was reach out to the higher up within that organization. So they reached out to the owner of the company, et cetera, and basically said, hey, I need your help with something. And that's how it started out. And usually when you start out with, I need your help with something, people are more receptive. And then basically laid out the situation that, look, we've got these outstanding invoices for several months. And this was a hospital that we were going to. Okay. So it's not a small company. And that got a response because now the higher up got that email and we position it that, hey, we're not sure what to do. We may have to cut off services, et cetera. We don't want to do that. We've had a long-term relationship, but, we're not
Mhm.
getting results from this department. That email, within 30 some minutes of that person reading that email, the person that we were trying to get a hold of that was ignoring us because of that $20 an hour person kind of a deal, all of a sudden sends an email and says, oh, sorry, we will look at getting this sorted out or whatever. And within a week and change, we got our money. But it was all started out, but I, need your help with something to somebody in charge that was a decision maker way above that particular person because they don't know what's going on all the time down in the trenches. And so when you brought it up to their attention, and now it's a position that someone that can make a decision, and more importantly, it comes back down saying, hey, why isn't this taken care of? This is a longtime vendor of ours. Man, the things changed really quickly.
And then there's this mental self-imposed fear of, oh my God, if I piss off the client, they won't buy from me anymore. Well, you know what? They're not paying you
Yeah.
now.
Good.
They're
No,
not
I
paying you
agree.
now. So you might as well just let them go. Thank you
Right.
so much for
Here's
leaving.
the
And
other
by the way,
Exactly.
my collections lawyer will be contacting you,
The other thing is, I think if you're dealing with larger companies, mainly you've got a handle on this. You have to be very clear on what their terms and conditions are. Because I
Exactly.
had a
Right.
client that
Yeah.
did a lot of work with Bloomingdale's, and Bloomingdale's literally almost bankrupted her. The terms and conditions were so favorable for them, not for her. So you've got to be very careful and read the fine print and see what the heck are you signing over here.
Right, because
Just
nobody cares about the
Mhm.
contract until everybody cares about the contract. So
Yes.
I really
Correct.
want to emphasize what Rochelle is saying, and that's why I want to step in there, is because we all look at it, okay, that's great. We have a good relationship, we sign it, but we didn't read the fine print like you say, and all of a sudden you go, oh, yikes, I have a
My,
problem with my
my
Well,
hands.
fine
and
print is
and
bold and it's thick and it's like 16 point on purpose. You
yeah,
approve invoices before, early or
yeah.
on time, and you agree to do the work that's prescribed to you. I mean, I'm very,
Mhm.
very explicit in my agreements because I don't want to hear no backlash. Oh, I didn't know. And you have 90-day cutoff. So you have 90 days to terminate our services. No problems, no questions asked, but it's a 90-day.
Right. To the point of large corporations, I can tell you that that's not an easy process either. Okay. We've done business with, the big three automakers and their vendors, for example, and it's a trickle down effect, essentially. So you do the work. First of all, you have, especially in advertising, not so much on the marketing side, labor management, but on the advertising side, you do the work, then you invoice it. Once it's invoiced, let's say you're working with their agency, they don't bill the client until 30 days later.
Oh my.
Yeah. Then the client turns around, if you're lucky, pays them
A buck
30
20.
days later, and then they turn around and pay you 30 days later. You're a good 90 to 120 days out when you're working with large corporations.
Yep.
Okay. That's
Yep.
so that's one story I'm going to say. The other story I'm going to share with you is something that's going on this year with one of our clients. Everything was fine first half of the year. We're getting paid within the 30 days. Summer rolled around and all of a sudden, well, 30 days have gone by, they haven't paid. Well, that's great. Okay. 45? Nope. 60. Well, we finally got paid on 60s. Now we're on a 60-day cycle. Well, that was good until August. And now it's looking more like a 90-day cycle. And this is a large corporation. And the reason for this scenario, for this example that I'm giving you, is that this large $2-3 billion company is owned mostly by a private equity company. The private equity company is figuring out everything that they can do to make their books look good by the time they get to whatever the fiscal year end is. In some cases, it's the end of October. In some cases, it's December. And what they're working on right now is to make those books look good so that they can have this grandiose party when January 1st rolls around. And so what are they doing? They're holding them back on those payments on purpose, playing games all the way through. So
Even
large,
smaller companies just aren't getting paid by these bigger companies, which affects the vendor, me,
exactly.
or
It's just
whoever.
a domino effect.
Yep.
Yeah,
Yeah,
what I
it's a
did, what I
domino
did
effect.
years ago for a software company that I was managing was to improve the cash flow. We had a order form that I had created that they would sign off on. So basically, here's the software, blah blah blah, and they would have to sign off. But there was a little check mark box that said 5% off with payment in full upon acceptance. And then there was an area for a credit card information.
Good
Just
idea.
about every CFO, I think it was 90% of them, took advantage of that, checked off the thing, gave us a credit card number, and we got our cash within a couple days paid up front because over a $10,000 or $15,000, 5% is a significant amount, and the CFO will take advantage of that. And what that did is it created cash flow for the company, and we got payment right with the order. It's just some, think sometimes out of the box to get, people to pay you quicker.
Here's the thing, if you do have
Yeah.
30 days if you do have a 30-day opportunity, I believe you make a call on day 31
Yep.
because they have to
You
know
got nothing to lose.
that you are, you're on the person that complains or goes after their money is the one that get paid first. So if you're just be like, kind and don't say anything, you're on the bottom of their pile of invoices.
The squeaky wheel gets the grease.
Right.
You got it.
Exactly. And I think
And
that's
you
the
may not,
that's
you may
that
not
that's been
like,
around for a
Squeak,
long
squeak,
time.
squeak. It's all I got to say.
yeah, you may not like it, but it's the only way. It's the
And,
only
and look, I'll be honest, as someone who's been a small entrepreneur to a fairly larger entrepreneur, when you're in your younger stages of entrepreneurism and your business is dependent on a lot less clients, it's simple and easy for us all to say, here, just fire them and get a new one. True. But you're saying to yourself, shit, I got 5 clients. If I fire 2 of my clients, I've only got 3 clients. So, but I will tell you that, you know what? It's a scary proposition, but it really is the right thing to do. and people will take you seriously, and just go in and say, look, I did the services for you. I need to get paid. I'm a small business. You're a small business. You should get that. How would you like it if none of your clients paid you? Watch how quick they're like, yeah, okay, you know what? I can't give you the whole $2,000, but I got $1,200 I can give you. All right, so fine. So I'll take the other 800 next week.
Let's say, I mean, you make a good point there. It's a negotiation process, right? Everybody runs into cash flow problems, whether you're working with large corporations or working with mom and pop operations. Doesn't make a difference. And so the question is, can you get something in the door instead of zero?
That's right. That's right.
Yeah, that's what we did with the, one of the hospital that I'm talking about. We ended up on some of the cases, can you get us these invoices that are 90 days past due? Can we get paid on those? At least get that part of it cleared up. And that's what we got accomplished because of the higher up. We got some of the ones that were really far out, 120 days and 90 days. We got those cleared off. Still, we had others that needed to be done, but at least we got the books looking a lot better that it wasn't 120 days past due.
The start.
Now it was only 60 some days past due. It's a start,
I agree.
exactly. But that was negotiation, and just like Melih said, we worked out something with them and you as well, Steve. We worked out something that said, let's help each other out.
You want to know when I started learning a little bit more about this concept of negotiating on invoices? It was the financial crisis. 2000, starting in late 2008, going into 2009 and 10. I mean, you want to talk about constantly negotiating during that period. Oh my God, this was worse than the pandemic. What a nightmare back in those days. I think a lot of us, that lived through that in that fashion, especially in my case, we're in Detroit. It was ground zero. The big three are filing for bankruptcy across the board. You want to talk about a trickle down effect all the way through. They're shoveling people out of Michigan, out of Southeast Michigan. It was just a disaster. But that's when you really start. Now you're in the trenches.
Right.
Now you're learning what to do in these types of situations.
There's a lot of industries that are notorious for late payment. And you have to realize, can your company deal with carrying and not getting paid in, let's say, 120 days? If you're doing government work, for the 100, you just won't get paid. If you're lucky, you
Yeah.
get paid 120. Now you have to decide, can your business cover that? And if not,
Mhm.
don't go into government work.
That's
period.
why it's good to have a relationship with a banker. Always a good idea.
Yeah. And you want to
got
stay
one of
away, and you
those-
want to stay away from those places that will give you cash up front for your invoices, because that becomes a nightmare as well, because now you're really paying more and you're actually making less money. Yeah, you got to, cash up front temporarily. You feel, oh, good, I got some money. But then you look at what you're paying for that money, and it's really not worth it.
20,
Hey, guys.
25%.
Let's cut it off for today and go start working through our takeaways. Who wants to start?
I will. An account only if it pays. If not, it's called a hallucination. You've got to be able to say, this is not who I'm dealing with, because it's not giving me the cash flow that I need. Not every account is an account.
Be creative on ways of getting your money either sooner or collecting outstanding money. Think out of the box.
Yeah, there's a good one. I was going to say, be upfront, loud, and proud about what your rules and accepted usage policies are on getting paid, and stick to
Sounds
them.
good.
Stick to them.
I'm going to go with a combination of things that we talked about today. So I'm going to say numbers tell the real story in business. It's your cash flow. Cash flow is not a promise, and you need to chase down payments. And with that, that is the end of today's show. That's it for this week of Business Lunatics. Hit follow, subscribe, and join the loonies next week for more no fluff, no BS, just pure business madness. Thank you very much.